Hi, I'm Alan Freeman, and I'm the managing partner of LifePath Advisors. We are a rapidly growing virtual wealth management firm. I hold the Certified Financial Planner designation. I was voted the favorite financial planner from Bluffton Magazine 2 times, the best of Bluffton by Bluffton Today magazine, and a finalist in the Post and Courier paper. I was featured in the book Inside the Minds: Wealth Strategies for Doctors as a co-author. And I'm holding a book by Patrick Kelly, and it's called Tax-Free Retirement. And this book has sold over 750,000 copies. And in a minute, I'm going to share with you how you can get this book for free. We talk and work with many high-income earners across the country. And initially, many of them, perhaps just like you, have simply heard or read this title and then asked, is that really possible? And I'm here to tell you that yes, it is possible. Even though many high-income earners have no way of knowing how to achieve it. This is not some gimmick or tax loophole. Actually, it's the opposite. It's a fully recognized, approved strategy of the Section 7702 of the IRS tax code. It's not complicated and virtually available to anyone who qualifies, but only if they have the privilege of working with a professional advisory firm who understands how to do it. If you're a high income earner and you're funding a tax qualified plan like a 401k, IRA, or cash balance plan, I need to ask you a very important question. Do you believe tax rates are going to be higher or lower in the future? You see, tax qualified plans don't save you taxes. They simply delay the tax. No one can guarantee what tax rates are going to be in the future. However, in the last 13 years, we have tripled our national debt. Think about that. It took us 232 years to accumulate $9 trillion in debt. And in the last 13 years, we've tripled that debt to $36 trillion. Our debt to GDP ratio is 127%. That is not sustainable. We're currently increasing our deficit by $1 trillion every 100 days. We're witnessing the retirement of the first generation of baby boomers, transitioning en masse onto Social Security and Medicare. Currently, only about 40% of boomers have retired, but by 2028, that number is projected to soar to 98%. This demographic shift represents a significant challenge to our country. Our own Congressional Budget Office has forecasted that tax rates, once the baby boomers are fully retired and on Social Security and Medicare, for the middle class, that tax rates will go from 25% range to somewhere in the 60% range in order to be able to afford all of the benefits that we've promised our baby boomers. Let me ask you another question. If there was a way that you could avoid this potential chaos and be able to access some of your money in retirement without state or federal taxes on either the principal or the gain, might you be interested? In a minute, I'm going to walk you through a strategy. If you want to pursue it, that's great. And if you don't, you won't. If you don't, you're welcome to go ahead and pay more taxes in retirement. The government and those who choose to take an active role in minimizing taxes will thank you for your tax contributions. Now, back to the book. This book sells on Amazon for $14.95, and I would like to offer it to you for free of charge. And let me assure you, there's no strings attached. When you receive it, commit to reading at least the first chapter, just 6 short pages. It will give you a vivid picture of the debt tsunami that we face and how it could affect your retirement in the years to come. Now, I'm going to walk you through this tax-free retirement strategy. Hi, I'm Alan. Thank you for joining me back from the earlier presentation. And I'm going to walk you through this strategy. And in the end, I'm going to share with you how you can get a link to this website so you can actually walk through this on your own. Comfort of your own home, anytime, day or night that you want to, so that you can determine if this is something that you want to pursue if you truly want to minimize taxes in retirement. This will answer 98% of your questions that you have. So I'm going to dive right into it. And we are here always available with our clients for this, as well as comprehensive financial planning that we do for our high net worth or high income clients that we have across the country. So I'm going to dive right into it, and I'm going to use kind of a scenario that we did fairly recently. We work with a lot of physicians, so I'm going to use a physician example of somebody that we've worked with recently. So when you log into this thing, the first thing you're going to see is this little 3-minute video. So I encourage you to go through that to kind of lay the foundation. And then the left-hand column over here is your menu, and you're going to go start at the top and you go all the way down to the bottom. And I'm going to briefly walk through it with you. So the next area we come is estimate your benefits. So we recently did this for a 50-year-old physician. I think he lived in Oklahoma or somewhere like that. And he, obviously 50 years old, he'd been practicing for a while. He maxes out his 401k every year, which this year I think is around $30,000 that he can do as an employee. And so the rest of his retirement is in taxable accounts. And anytime he has a gain on something and sells it, he's got to pay taxes on it, or rebalancing, he's got to pay taxes on it. So he's got a good chunk of money in his 401k, but the problem with that is nothing has ever been taxed on it. So, let's say, I don't know, if he has like $1 million, well, if he's in a 37% tax bracket, 37% of that money is not his. It's the government's. So, we have to calculate his cash flow at retirement based on the net of that. What, $600,000? So, and then the rest of it's in taxable accounts. So that's kind of a lay of the land of kind of in the scenario that I'm going to present this 50-year-old, $1 million in a 401k, I don't know, $400,000 or $500,000 in taxable accounts, makes good money, I don't know, $400,000 or $500,000 a year. So we're going to start with your age, and I'm going to go with an example with him. We put in 50 years old. He's a guy, and remember, this is a 5-year contribution. Okay, that means that everything that I'm talking to you about is only a 5-year commitment to funding. Okay, so and it says it right here. How often will you contribute? 5 years. All right, so he's going to contribute for 5 years into this plan and then leave it alone. Okay, so that's where we're going. So because he's got taxable brokerage account, and he said, well, from cash flow, I can probably throw, $40,000 a year in addition to what I'm doing in my 401k, because I just got that excess stuff that's going into my brokerage account. All right. So that's $40,000 that he can contribute. And I said, well, what if you take a little bit more that's already in your brokerage account and we add to that? Okay. So in this example, between he and his wife, they were able to commit roughly about $70,000 a year for a 5-year window. Okay, so that's what we're looking at. So he's 50 years old, male physician. He can contribute $70,000 a year for 5 years. Okay, and then we hit calculate. And what that does is it comes down here and it actually visually walks you through what the process is. So there's a contribution that he makes as a client, and then there's the lender, and we'll go through more of that in the future, but there's a lender out there that's going to match his contribution, okay? It's going to leverage his contribution and match it dollar for dollar, okay? So he puts in, what did I say, $70,000 a year. The lender's going to put in $70,000 a year for his 5-year commitment. Then after that, my client is finished his commitment of funding this, and the lender's going to step up and match both contributions. He's going to put in $140,000 a year for 5 years for my client, okay? So when it's all said and done, after 10 years of funding this, my client's put in $350,000. The lender has contributed a little over $1 million. So in 10 years, we're starting this plan off with $1.36 million in contributions inside of here. Okay, let's do a little math. So he made a 5-year contribution of $70,000. So he put in $350,000, and that was his contribution, left it alone. And then if you take his distribution of $2.3 million for 24 years, over 24 years, and his $1.3 million death benefit, and you add those numbers together, that's $3.63 million. So he put in $350,000. He gets tax-free income and death benefit of $3.63 million. That's a pretty good trade-off. Now let's look at some alternatives. If we did this same thing without leverage, and let me back up a minute. You're saying, well, where did you get all these numbers? I'm going to go through that, but the rest of this presentation tells you how we did that. But all of the assumptions here is assuming the same thing. We're assuming a 6.74% rate of return. We're assuming a 20% capital gains tax, and we're assuming a 37% income tax on all 4 of these scenarios. So if we go to the index universal life without the leverage, without the leverage that the lender's providing, the income goes down to $64,000 in tax-free benefit, which you multiply that times 24 years is $1.6 million. And there's an initial death benefit of $960,000, pretty decent. And after age 90, he's got a death benefit for his heirs at $450,000, okay? Now, let's move on to after tax, all right? Remember his brokerage account? He was throwing money into his brokerage account. Well, let's say he did the same thing. He took $70,000, threw it into his brokerage account for that same rate of return, capital gains, income tax rate. He could only pull out after tax $46,000, which is about $1 million over that 24-year time span. But there's no death benefit for his family, nothing at all. And then we'll go to what the CPAs really love, and that is a 401k. Max out your 401k, defer those taxes, save those taxes. You're not saving taxes. You're just deferring them later on. So when tax rates go up and you start taking that money out, you're taking all that money out at a higher tax rate. Real smart, isn't it? So this is the traditional 401k route that 99% of the people are on. They pre-tax dollars, $70,000. They put it into a pre-tax account. They do that for, this is just a 5-year plan, so we're comparing apples to apples, okay? By the time he takes that out, after his rate of return, he's taking out $58,000 after taxes. Multiply that out times the 24 years, and that's $1.4 million. And just like your 401k, you don't have a death benefit, your spouse doesn't get anything. So for the same contribution of $70,000 for 5 years and then not touch anything, which one is more attractive? $93,000 in tax-free income for 24 years, which is $2.3 million tax-free when you're retired, or what most people are doing right now, same scenario, $58,000 after tax, a total distribution of $1.4 million, and your spouse, your heirs, your legacy gets nothing except what's left over. All right? Let's go a little bit deeper into how all this works. And I'm going to run through this part pretty quickly because this is what you can learn and educate yourself on your own time, because this is designed to answer 98% of your questions. Okay? And then we go through, how does this leverage work? Okay? Well, think about it when you bought a home. Why did you get a mortgage? Because you wanted a bigger house. You put down a couple $100,000. You went to the lender and say, I've got this collateral, this big house that I want, and bank, will you lend me money on this house so I can get a bigger house? Well, it's the same concept with your retirement, okay? You want a bigger retirement, you use leverage. You use other people's money to get a bigger retirement, and that's what we're doing here. So it's bank financing on your retirement. And you know what? With this leverage, when you got a mortgage, you had to sign a lot of papers and you were responsible for a lot. On this, there's no interest payments, there's no loan documents, there's no credit check, and there's no personal guarantees. Next step is, well, if I want to explore this, how do I do this? Well, somewhere in the information I'm presenting, there's going to be a place for you to send me your email address. And when you send me your email address, I'm going to send you a link that will give you access to what I just shared with you. And you can go through it as much as you want to and sign in and play with it and come up with your own conclusion. Is this something that's going to be beneficial to my family so that I can save taxes, so I can choose where I want to spend my money without it being going to the government? Okay? So another quick analogy that somebody said, it's like, all right, you're going to go get a new home, and you want to get this home for $750,000, and you go to the bank, and the bank says, yeah, we'll give you that $750,000 loan for that house, but under one condition. We're not going to tell you the interest rate we're going to charge you until after the 30-year loan. After you pay for the 30-year loan and pay off the house, then we'll tell you what the interest rate is that you got to pay us back. Okay? That's the same scenario that you're doing with your 401k or cash balance plan or forfeit, any tax deferred plan. Okay? None of that money's been taxed, and you've got to deal with the government, and the government says, go ahead and sock that money away. Your CPA said, max out that 401k. Yeah, save those tax dollars, max it out, okay? And you do that for 15, 20-something years, okay? And the government says, all right, our deal is you don't have to pay any taxes right now. And we're at an average 25% tax bracket. We're in the lowest that we've been in 80 years, okay? Lowest tax bracket in 80 years. But you know what? The government says, go ahead, we'll give you an incentive. Don't pay taxes on that now. But come when it's time, when you're ready to retire and start taking distributions out of that $2, $3, $4, $5 million account, the government's going to say, you know what, we didn't tell you what interest we were going to charge you on that, meaning we didn't tell you what taxes are going to be coming out of that. And you know what, they're probably going to be much higher in the future than they are now. So do you want to be in that scenario with the government, just like in the mortgage scenario? I would suggest not. We get an email from you with your information. We send an email back to you with a link. You can go and you can sign in and you can explore all of this on your own. You can reach out to us. We can walk through it with you on the screen, okay? You can ask questions and we can go from there. The ball's in your court, okay? If you want to pay less taxes, there's only a couple of ways of doing it, okay? It's not rocket science. There's only a few ways to do it, And this is a strategy that we work with a lot of high income earners across the country. So with that, I'm going to leave you. If you've got questions, reach out. Let's jump on a video call and see how we can help you create a vision, values, and goals for your life with aligning your financial resources with what's truly important to you. All right. Thank you so much.